Hello, and you're welcome to Global Business Insights, where we look at headlines all over the world from a global business perspective. Our main story is UK inflation, which decreased to 2% in May from 2.3% in April, hitting the Bank of England's target. Initially, the pound was stable, but as markets digested the details, we saw the pound later inch up, a sign that the lingering stickiness in core services inflation is still seen as convincing the Bank of England's Monetary Policy Committee to hold its benchmark rates. We will discuss the Bank of England decision tomorrow. The AI hype continues to defy concerns on the economy and high interest rates as the US Federal Reserve awaits more data to be confident on next steps. Yesterday, Nvidia's stock soared 3.5%, overtaking Microsoft and emerging as the most valuable stock in US markets. Today, US stock and bond markets are closed for the Juneteenth holiday. Crude oil continues to inch up. Now it's slightly lower, but still over $85 a barrel, as Brent seems to have recovered all the losses incurred after the last OPEC Plus meeting. And talking of AI, we have Mr. Niyi Yusuf, Managing Partner, Verraki Partners and Chairman, Board of Directors, Nigeria Economic Summit Group, to discuss the implications of the artificial intelligence revolution for developing economies and the importance of collaboration at the continental level to avert AI exclusion.
On the continent, and certainly in Nigeria, we're faced with a situation of financial exclusion and increasingly also digital exclusion. But what is more worrisome is potential for AI exclusion, artificial intelligence exclusion. The continent is more of a consuming continent as opposed to being part of the production when it comes to technology systems, science, innovation, R&D, and scientific development, etc. And so we need to ensure we change the dial and ensure that Africa, Nigeria does not become, that is not on the losing side, on the short stick of the AI revolution, because AI is there to come. And so it was gladdening to see over the weekend that the Committee of Ministers of ICT in Africa, under the African Union, the auspices of the African Union, came up with the Africa Continental AI Strategy. The AI strategy for Africa that is focused on a few things. The strategy needs to be people-centered, inclusive, must be development-oriented, and must drive the right infrastructure, must drive innovation, must support customer protection, consumer protection, data privacy. But more importantly, we also ensure that we have the right data sets. AI is based on the data that is used to teach the AI. And if African history is as written by others for us, then the AI algorithms will have certain biases against the black man, against Africans. So it's important that we create African stories, African data sets, and let those be used to teach the AI. And so focus on the infrastructure, focus on skills development, on talent development, on the right regulations around AI governance, ethical AI, what you call responsible AI. Like Rwanda has done. Rwanda has come up with its own national AI strategy. And part of that is our public sector will embrace AI, but more importantly, our private sector will use AI in a very ethical and responsible way. And so other African countries also need to do that. Nigeria has started that journey with what Minister Bosun Tijani has done in the last few months. And I hope that if we all work together collaboratively, not just as countries, but as the continent as a whole, under the auspices of the EU, we might avert the potential for AI exclusion.
It's surreal. Nvidia has posted a total return of about 600,000% since its initial public offering in 1999, when shares were priced at $19.99. And it's a testament to how investors see Nvidia, the single biggest winner of the AI boom. Nvidia has now overtaken Microsoft and Apple to emerge as the most valuable publicly listed company in the world. The Silicon Valley US-based company Nvidia, founded just 31 years ago to build PC graphics cards for video games, has in the past year seen successive quarters of huge revenue growth, announcing a 265% year-on-year increase in February, 262% increase in May. Its shares are up roughly 170% since the start of the year. Its meteoric rise is in the design of highly sought-after AI chips, the brain behind processors driving the latest generation of computers. Google, Microsoft, and Amazon have all lined up buying its Hopper series of graphic processing units for their cloud services. NVIDIA's software ecosystem, CUDA, which offers tools for developers using its chips, has also cemented a rare dominance. Even the AI bulls are warning it's a bit too good to be true. Competitors like AMD and Intel have launched their own competing AI chips, but are still far from eroding NVIDIA's commanding edge. Most of its valuation is linked to futuristic aspirations of what AI will do, and in an economic growth scenario that is still fraught with much uncertainty, my conclusion has to be to proceed with utmost caution if you must dive heavily into NVIDIA, as most agree its dominance will eventually be broken, but it's not likely to happen soon. I still favor, say, an Apple with an easier to understand value proposition, but no one can ignore NVIDIA now being called the Magnificent One, as it stands out amongst the top 5 most valuable US companies, which, by the way, are all technology companies. It seems the upside momentum is firming for crude oil. Oil markets are looking to see the peak driving season in the summer support prices, but gasoline demand so far has been less than expected. US consumption is 2% lower year over year. The pressure on gasoline might, however, increase later, as this year's 2 main refinery new builds, Nigeria's Dangote and Mexico's Olmeca, are both delayed and may not produce in time to support summer demand. Oil prices have gradually recouped all their losses following the OPEC Plus meeting, and Brent is back to over $85 per barrel, though quite volatile. I can see it was up earlier in the morning. It's now slightly down today as we speak. Global macroeconomics may be looking more positive, as comments from the US Fed and others this week persuade the market that demand may be creeping back with better economic growth. Inventories are, however, piling up in the US. The American Petroleum Institute reported US crude inventories up by 2.3 million barrels last week, the third increase in a row. High inventory points to ample supply as the US opens the taps and pulls from strategic reserves to keep prices down. I expect fully that prices will be low till after the US elections. EVI is still predicting sub $80 per barrel on average for Brent in the year. However, on the demand side in Asia, refiners are restoring some capacity following maintenance, boosting crude consumption and demand. Other oil and gas news: Total Energy sold its Brunei upstream business to Malaysian exploration firm Hibiscus Petroleum for $260 million, providing funds for further Namibia drilling. Shell agreed to buy Singaporean LNG firm Pavilion Energy from investment firm Temasek, taking over its 6.5 million tons per annum portfolio of long-term supply contracts and strengthening its position as the world's top gas trader. Now to UK inflation, the main analysis for today. Consumer Prices Index CPI rose by 2% in the 12 months to May 2024, down from 2.3% in the previous month. Month on month, CPI rose by 0.3% in May compared to 0.7% in the previous year. The largest downward contribution to the monthly change came from food, with prices falling this year but rising a year ago, while the largest upward contribution was from motor fuels, with prices rising slightly this year. The sticky core consumer price index, excluding energy, food, alcohol and tobacco for services, eased only slightly from 6% to 5.9%. Now that is something that the BOE will be watching. That's the services, the core services inflation data at 6%, while the core CPI, excluding energy, food, alcohol, and tobacco itself, rose by 3.5% in May year on year, down from 3.9% in April. So some progress there. But significantly, it was the first time inflation has been at the Bank of England's target since July 2021. The Bank of England has an important decision to make as Britons moan under high interest rates. One more reason to change leadership as elections take place next month. Tomorrow, the bank's Monetary Policy Committee will announce its latest decision on interest rates. If indeed it cuts rates just 2 weeks before election day, it may risk being accused of favoring the Conservatives. But given the inflation data today and the ECB decision to cut rates despite not having anywhere near as good inflation data, added to a flat economy in April, dampened by the wet weather in the UK, which was, of course, a poor start to the second quarter. If the Bank of England still holds, of course, it will be accused of bias towards the Labour Party. Navigating the political tightrope can be tricky. The easiest scenario would have been if today's inflation had sprung an upside surprise. It did not. The Bank of England would have simply folded its hands and justified a decision to hold. Already, MPC members were warned to make no comments since the decision to hold the election on July 4 was announced, fully aware that any comment could be leveraged by politicians. 2 members of the 9 at the last meeting voted for a cut, so we need only 3 more. The MPC has never changed interest rates at the meeting immediately before a general election, and it's prudent to wait to fully understand implications of a possible leadership transition. Sunak will be taking his victory lap, bringing down inflation from over 11% in October 2022 is no mean feat. Others say the drop in energy prices did the trick and not the Bank of England or anything Sunak did. Still, it must put the Bank of England's MPC and the Conservatives in a much better mood. Whatever the Bank of England does and whoever assumes the helm of leadership, most likely Starmer based on the polls. My view is that there are no magic bullets, and the road to recovery of the UK economy after multi-shocks of COVID, Ukraine and Brexit is a hard one. The Confederation of British Industry, CBI, said the stage was now set for the Bank of England to cautiously cut interest rates. I think it's 50-50 that we get a cut tomorrow. The odds may still slightly favor a hold. The earlier ECB cut, I think, would also have helped. The UK is remarkably ahead of the ECB on inflation. Indeed, the UK is the first major economy to have met its 2% inflation target. In the US, they don't expect to see 2% till perhaps 2025. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Thank you very much for watching. Bye-bye.